Beneath the glow of America's booming past, a storm is quietly tearing through the real estate landscape, and it's far worse than anyone expected. In 2025, home prices in once thriving cities like Phoenix, Cape Coral, and Orange County are plunging by 15% to 24%, wiping out over $120,000 in equity for countless families. Over 50% of listings now sit with slashed prices, while mortgage payments have doubled, hitting $3,000 a month or more. Builders are halting projects. Investors are dumping homes in desperation. This isn't just a correction, it's a housing freefall. These are the 10 U.S. cities where the market is truly falling apart. Number 10. Atlanta, Georgia. Atlanta, Georgia, once a darling of Sunbelt migration, is now feeling the pressure of the 2025 housing crash. After years of explosive growth, the city is seeing a sharp reversal. In 2020, the median home price in Metro Atlanta hovered around $265,000, but it skyrocketed to $402,000 by mid-2022, a staggering 51% increase. Fast forward to 2025, and the tide has turned. Home values have fallen 12% year over year, bringing the median down to around $353,000. Some suburban areas like Stockbridge and McDonough have seen drops of over 18%. Atlanta's housing inventory has ballooned to over 28,000 active listings, up 92% compared to this time last year. Buyers are hesitant, sellers are slashing prices, and nearly 42% of all listings have had at least one price cut. Days on market has doubled from 19 days in 2022 to over 41 days in mid-2025. Builders have hit the brakes hard. New construction permits are down 36%, and hundreds of developments are on pause. Affordability is a major culprit. The average mortgage payment for a median-priced home has jumped from $1,200 in 2020 to over $2,600 in 2025 due to 7% mortgage rates. The city's wage growth hasn't kept up. While median household income in Atlanta is around $75,000, the debt-to-income ratio for new buyers is now dangerously high, over 43% in many zip codes. Investor pullback has worsened the correction. Atlanta was a top target for institutional buyers during the pandemic, but now those same investors are liquidating. Some are offering 5% to 10% discounts to offload rentals that are sitting vacant as rent growth stalls. In 2023, Atlanta's rent grew 11%. In 2025, it's flatlining or declining in many neighborhoods. Atlanta's red-hot streak has officially cooled, and it's not warming back up anytime soon. Number 9. Denver, Colorado. Denver's mile-high real estate market has come crashing down to earth in 2025. Once a magnet for remote workers and urban adventurers, the city is now facing a severe correction. Back in early 2022, the median home price in Denver hit a peak of $615,000, a 40% surge in just 2 years. But in 2025, prices have dropped to around $543,000, a 12% decline, with higher-end suburbs like Lone Tree and Highlands Ranch seeing even steeper drops nearing 17%. Inventory tells a revealing story. Denver now has over 11,500 active listings, compared to just 6,000 a year ago, a 91% surge. Roughly 39% of homes listed have had price reductions, and homes are lingering on the market for 47 days on average, up from 21 days in 2022. Buyers have clearly backed off, and builders are reacting. New construction permits are down 33% in 2025 compared to last year. Affordability is at a breaking point. Mortgage rates hovering around 6.9% have pushed average monthly payments to over $3,600 for a typical home, pricing out many local buyers. Denver's median household income is $82,000, but that's not enough to comfortably afford a median-priced home without exceeding the 40% debt-to-income threshold. The rental market, once Denver's safety net, isn't offering relief either. Average rents have plateaued at around $2,000 per month, with vacancy rates climbing to 6.3%, the highest in 7 years. Institutional investors who gobbled up properties during the boom are now offloading homes at discounted rates to limit their exposure. With rising inventory, falling prices, and affordability in crisis, Denver's housing boom is officially over. and it's not bouncing back quickly. For many sellers and investors, the high-altitude pain is just beginning. Number 8. Bakersfield, California. Bakersfield, California, long seen as one of the last affordable cities in the state, is now in a freefall. While cities like San Francisco saw their booms cool earlier, Bakersfield's crash has hit late and hard. In 2022, the median home price here hit $405,000, but by mid-2025, it's dropped to around $337,000, a 16.8% drop that has shocked many first-time buyers and flippers alike. Inventory is overflowing. The number of homes for sale has surged by 88% year-over-year, reaching over 4,800 active listings in a city that typically hovered around 2,500. More than 46% of those listings have experienced at least one price cut. Homes are sitting on the market for an average of 51 days, compared to just 18 days during the pandemic boom. Builders have paused nearly 40% of planned new builds as the market stalls. Affordability was once Bakersfield's main appeal, but that's quickly eroding. Mortgage payments on a $337,000 home with 7% interest and 20% down now sit near $2,200 a month, a sharp contrast to just $1,300 a month in 2020. That's a crushing blow for a city with a median household income of only $63,000. The investor exit is intensifying the decline. Large property buyers that had expanded into Kern County are now fleeing, liquidating rentals and walking away from projects. Vacancy rates have jumped to 8.1%, and rental prices are softening, with some neighborhoods seeing drops of 6% in just 6 months. Once seen as a pandemic-era haven for priced-out Californians, Bakersfield is now grappling with the aftermath of overvaluation, overbuilding, and evaporating demand. Sellers are slashing prices, and buyers are either priced out or just waiting for the bottom. The Central Valley's dream of stability has turned into a harsh reality check. Number 7. Tampa, Florida. Tampa, a pandemic-era real estate superstar, is now undergoing one of the most aggressive market resets in Florida. In 2021, Tampa's home prices soared an astonishing 28% in a single year, with the median home price peaking at around $430,000 in late 2022. But in 2025, that number has slipped to $377,000, a 12.3% drop, with steeper declines in outlying areas like Brandon and Riverview. Inventory has absolutely exploded. Tampa's active listings have surged to $22,000, up from just $10,300 the previous year, a jaw-dropping 113% increase. Over 44% of homes on the market have had price reductions. Many sit unsold for 60-plus days, double the average from 2 years ago. And builders are panicking. New housing starts are down 41% year-over-year, with many developers offering up to $30,000 in concessions to lure buyers. Affordability is wrecked. With mortgage rates at 6.8%, the average monthly payment on a median-priced home has climbed to over $2,900 a month, up from just $1,600 in 2020. Tampa's median household income sits around $65,000, leaving many priced out of the dream they chased just a few years ago. Florida's high insurance premiums are adding fuel to the fire. In Tampa, average annual homeowners insurance has jumped to $4,500, nearly double the national average. Combined with rising HOA fees and taxes, the true cost of ownership has become unbearable for many. To make matters worse, investor sentiment is rapidly shifting. Tampa was a favorite among institutional buyers during the boom. Now, they're dumping properties at a loss. Rents are also falling, down 6.2% year-over-year, with vacancies climbing and demand softening. Tampa's sunny housing market has turned stormy, and for thousands of sellers, the clouds just keep getting darker. Number 6. Dallas, Texas. Dallas was once the crown jewel of Texas real estate, attracting floods of Californians, tech transplants, and investors looking to capitalize on the Sun Belt boom. But in 2025, the market is buckling under the weight of its own success. The median home price in Dallas-Fort Worth peaked at $435,000 in 2022. As of mid-2025, it's down to $385,000, a decline of 11.5%. with suburbs like Frisco and McKinney witnessing drops closer to 15%. Active listings have soared to over $34,000, nearly double the inventory from a year ago. Nearly 47% of homes on the market have had at least one price cut. Average days on market have jumped to 58 days, up from just 19 during the peak frenzy. Builders, once scrambling to meet demand, are now canceling projects. New housing starts are down 38% year over year. Affordability has crumbled. A typical 30-year mortgage at 7% interest on a $385,000 home now requires payments of $2,700 a month, compared to just $500 a month in 2020. Dallas's median household income is around $74,000, pushing many buyers above the safe 40% debt-to-income threshold. Texas property taxes add to the squeeze. With an average effective tax rate of 2.1%, homeowners pay around $8,000 a year on a median home. Add in rising insurance, now averaging over $3,800 annually, and owning in Dallas has become a financial headache. Investor sentiment has turned negative. iBuyers and rental investors are scaling back, slashing prices to offload vacant homes. Rent growth, once red hot, has gone flat, and vacancy rates are rising. What was once an unstoppable Texas housing rocket is now sputtering, and many fear it hasn't hit bottom yet. Number 5. Las Vegas, Nevada. Las Vegas is no stranger to housing drama, and 2025 is proving to be another brutal chapter. After a pandemic-fueled surge, the Vegas housing market is now collapsing under its own weight. In 2022, the median home price in Clark County hit $475,000, a 43% increase from 2020. But now, in 2025, that number has plunged to around $407,000, a 14.3% decline citywide, with deeper drops in areas like North Las Vegas and Henderson. Inventory has ballooned. Active listings have jumped 117% year over year, climbing from 6,900 to over 15,000 homes on the market. Over 48% of homes have slashed prices, and the average days on market has increased from 24 to 63 days. Builders have drastically pulled back, with new construction starts down 42% from last year. Several developments have been halted mid-construction. Affordability is in shambles. A 7% mortgage on a $407,000 home now costs around $2,800 a month, up from $1,400 just a few years ago. Meanwhile, Vegas's median household income is only $68,000, leaving many locals locked out of ownership. Tourism-dependent jobs haven't provided the income stability needed to match housing costs. Investor fallout is intensifying the correction. Vegas was a speculator's paradise during the boom, with nearly 18% of homes bought by investors in 2021. Now many are bailing, listing properties at fire sale prices. Vacancy rates for rentals are pushing 7.4%, and rents have dropped 8.1% year over year, signaling weakening demand. Las Vegas is once again living up to its reputation, not just for high-stakes gambling, but for extreme housing market swings. And this time, the house isn't winning, it's folding fast. Number 4. Boise, Idaho. Boise was the surprise superstar of the pandemic housing frenzy. Between 2020 and 2022, home prices soared by over 50%, with Californians and remote workers flooding the city. The median price hit a record $585,000 by mid-2022. But in 2025, Boise is ground zero for a stunning reversal. Prices have dropped to around $447,000, a 15% fall, with some neighborhoods like Kuna and Caldwell seeing losses nearing 20%. Inventory has exploded across Ada and Canyon counties. Boise now has over 5,400 active listings, up from just 2,300 a year ago, an astonishing 135% increase. Nearly 51% of homes on the market have reduced prices. Homes that once sold in bidding wars within 3 days are now sitting for an average of 68 days. Affordability has collapsed. A 7% mortgage on a $447,000 home costs around $3,000 a month, up from $1,600 a month in 2020. Boise's median household income is $72,000, making ownership nearly impossible for many without dual incomes or large down payments. Investor pullback has accelerated the correction. Boise was a favorite for flippers and out-of-state landlords. In 2021, nearly 1 in 4 buyers were investors. In 2025, many are cutting losses. Rent prices have declined by 5.7%, and vacancy rates have crept up to 6.1%, signaling softening demand. Builders are reeling. Permit applications are down 44%, and several planned subdivisions have been shelved. Some homes are being completed and immediately discounted by $40,000 or more just to attract a buyer. Boise's pandemic glory days are over. What started as a boomtown fairy tale has turned into a cold, costly awakening for thousands of homeowners, builders, and investors alike. Number 3. Cape Coral, Florida. Cape Coral is no longer just a beachside retirement haven. It's now a front-row seat to Florida's sharpest housing crash of 2025. During the pandemic boom, home prices soared over 60%, peaking at a median of $465,000 in mid-2022. But in 2025, that dream has unraveled. Median prices have now plunged to $385,000, a 17% year-over-year drop, with some neighborhoods like Northwest Cape seeing declines nearing 24%. The market is drowning in listings. Active inventory in Lee County has more than tripled, jumping from 4,800 in 2023 to over 15,000 today. Over 52% of these listings have had at least one price cut. Average time on market? 76 days, up from 21 in 2022. Builders are hitting the brakes hard. New housing starts are down 48%, and hundreds of homes are sitting unfinished or being fire-sold at massive discounts, sometimes over $50,000 off original listing price. Affordability has collapsed. Mortgage rates near 6.9% mean monthly payments on a $385K home now hover around $2,900, plus taxes and insurance. And here's the kicker. Homeowners insurance in Cape Coral now averages over $6,000 a year, one of the highest in the U.S. That alone adds $500 month-to-monthly costs. Investor panic is setting in. Cape Coral had one of the highest investor shares in Florida during the boom, with 30% of homes bought by non-primary residents. Many of those homes now sit vacant. Rents have fallen 9.2% year over year, and vacancy rates are creeping toward 10% in some zip codes. What was once Florida's hottest housing market is now a cautionary tale. The sun still shines, but for homeowners and builders here, the future looks very stormy. Number 2, Orange County, California. Orange County, home to Disneyland, sun-drenched beaches, and some of California's priciest zip codes, is now experiencing a dramatic real estate correction. After peaking at a median home price of $112 million in 2022, values have since fallen to $964,000, a 14% decline, and even higher in cities like Tustin, Anaheim Hills, and Laguna Niguel. Inventory has spiked sharply. In 2024, Orange County had around 2,500 listings. In 2025, that number has ballooned to $6,100, up 144% year over year. Nearly 49% of homes have reduced prices, and the average time on market has doubled to 58 days. Even luxury homes, once snapped up in days, now linger unsold, and open houses have become eerily quiet. Monthly costs have become staggering. A typical mortgage on a $964,000 home at 7% interest requires nearly $6,400 a month in payments, not including HOA fees, insurance, or taxes. Property taxes alone can run over $12,000 a year, and homeowner insurance in wildfire-prone areas has skyrocketed, with some premiums hitting $5,000 plus annually. Affordability has vaporized. The average household income in Orange County is around $105,000, but you'd need over $190,000 a year to comfortably afford a median-priced home in today's rate environment. That mismatch is freezing out first-time buyers and pushing many to rent. Yet even rentals are down 5.3%, with vacancies rising. The investor retreat is also underway. iBuyers, hedge funds, and flippers who stormed into SoCal during the boom are now offloading homes at up to $100K losses. New construction is down 37%, and even longtime developers are pressing pause. For years, Orange County defied gravity, but in 2025 the crash has caught up, and even paradise has a price correction. Number 1. Phoenix, Arizona. Phoenix has become ground zero for the 2025 housing crash. Once one of America's fastest-growing metros, the desert oasis is now a cautionary tale. At the market's peak in mid-2022, Phoenix's median home price hit $475,000. In 2025, it has plummeted to $403,000, a 15.1% year-over-year drop, with outlying areas like Maricopa and Surprise seeing losses nearing 22%. Inventory has absolutely exploded. Active listings jumped from 8,600 in mid-2024 to over 18,400 in mid-2025, a 114% surge. Over 50% of listed homes have had at least one price reduction. Homes that once sold in 3 days are now sitting for an average of 72 days. New construction is down 42%, and developers are offering massive incentives, up to $35,000 off and full closing cost coverage just to move inventory. Affordability has been wrecked. A 7% mortgage on a 403k home now demands a payment of around $2,750 a month, up from $1,400 a month in 2020. Median household income in Phoenix is $71,000, but that's no match for current cost burdens. Nearly 48% of households exceed safe debt-to-income thresholds when buying today. Rental demand is also slipping. Average rents have fallen 6.8%, and vacancy rates are climbing, especially in multifamily complexes built during the boom. Institutional investors, once buying 1 in every 5 homes, are dumping properties at deep discounts, further accelerating the crash. In 2021, Phoenix was the poster child of pandemic-fueled growth. Now, in 2025, it's the poster child of a full-blown housing collapse. For builders, sellers, and investors alike, the heat has turned toxic, and the fallout has just begun.